You know, for the longest time, that little carbon neutral stamp was like a golden ticket for companies. A super simple way to signal, hey, we're doing our part. Well, it looks like that ticket is expiring. What used to be a brilliant marketing tool is now turning into a massive legal and financial liability. Today, we're going to break down the crisis that's shaking the entire carbon offset market to its core.
And this isn't just about a few bad headlines anymore. We have officially entered a new era. We're talking about climate litigation, where the term carbon neutral isn't just a friendly buzzword, it's a claim that is being legally challenged and torn apart in a court of law.
So, let's dive into the real-world fallout. This is the point where those glossy corporate sustainability reports slam right into the cold, hard reality of legal action.
And listen, we are not talking about small-time players here. We're seeing industry titans like Apple, KLM, and Delta getting dragged into court. Apple is literally being sued over its carbon-neutral watch. A Dutch court has already ruled that KLM's sustainability ads were flat-out misleading. And Delta, well, they're fighting a huge class action lawsuit over their own carbon-neutral promises. This isn't some niche issue. It's a systemic problem hitting the biggest names out there.
Okay, so how on earth did we get to this point? To really understand the lawsuits, you first have to understand the shaky mechanics of the market they're challenging. Let's pull back the curtain on how carbon offsets are supposed to work, and more importantly, where all the cracks are starting to show.
The basic idea is actually pretty simple. A company puts a ton of CO2 into the air, so they pay for a project somewhere else that supposedly takes a ton of CO2 out. It's kind of like trying to balance a climate checkbook. But here's the massive catch. The actual value and quality of these offsets, it's all over the map. And this right here is the absolute heart of the problem. Think about it like this. An emission reduction is like promising you won't throw more trash into an already full landfill. Okay, good. But a carbon removal is like actually showing up and hauling trash out of that landfill. You see the difference? One just stops the bleeding. The other actually tries to heal the wound. It's a world of difference.
And this chart from the University of Oxford lays it out perfectly. It shows the whole spectrum of projects. Over on the left, in yellow, you've got the emission reductions. Think renewable energy projects. Then, as you move to the right, into the blues, you get into actual carbon removals. Everything from planting new forests to high-tech stuff like direct air capture. It's pretty clear there's a huge range in quality, how permanent they are, and how much risk is involved.
So this all leads us to the main event, a massive systemic failure in the voluntary carbon market. We're talking about a full-blown crisis of integrity.
Okay, I need you to remember one word. It's the most important concept in this entire space. Additionality. It's this simple but incredibly powerful idea that the money a company paid for an offset is the only reason the climate-friendly project happened, right? If that wind farm was going to get built anyway, or that forest was already protected, then paying for a credit from it does absolutely nothing extra for the climate. The offset is not additional. It's worthless.
And this isn't just some academic theory. It's the central argument, the smoking gun, in the lawsuit against Apple. The plaintiffs are basically saying that the projects Apple paid for lack additionality, meaning the climate benefits they're claiming would have happened anyway, with or without their money. So, just how widespread is this issue? Well, get ready for this number. It is staggering. According to the Berkeley Carbon Trading Project, a mere 3.3% of all the carbon credits on the major registries come from genuine carbon removal. Let that just sink in for a second.
I mean, it just forces you to ask the question, right? If more than 96% of the market has nothing to do with actually removing carbon from the atmosphere, what are companies really getting when they buy an offset and slap that carbon-neutral sticker on their product? The answer is they're mostly buying cheap, low-quality avoidance credits, many of which have huge question marks hanging over their integrity and their additionality.
But you know, this crisis is also forcing a long overdue correction. We're finally seeing a clear shift away from this mess and toward real, credible solutions. And probably the most influential guide for this is coming straight out of the University of Oxford.
And here they are, the Oxford Principles. The logic is just so powerful and clear. Number one, and this is the big one, cut your own emissions first. Don't even think about offsets until you've done that. Then, for whatever you absolutely can't cut, you have to shift your offsets toward 100% carbon removals. And not just any removals. You need to focus on ones that store carbon for the long haul, durably. And finally, use your wallet to help build this new high-quality market.
This chart is the perfect visual for what that strategy looks like in the real world. A company's portfolio of offsets needs to look like this over time.
You see? It might start with a mix, but it has to steadily and intentionally move away from those yellow avoidance credits and go all in on the dark blue durable removal credits. This is exactly what we mean by the flight to quality.
So, what's the bottom line here? What does this mean for the market moving forward? Well, it means we are witnessing a fundamental split in the world of carbon credits. That's really the key takeaway. It is no longer just one big market. What's happening is a great divergence. You've got the low-quality, sketchy credits on one side, which are fast becoming a huge liability, and on the other, you have high-quality, high-integrity removal credits, which are seeing skyrocketing demand.
And this isn't just a theory. We can see it happening in the data right now. The latest World Bank report shows this split in black and white. Prices for those low-quality renewable energy credits, they've crashed. Meanwhile, the actual use of high-quality, nature-based removal credits is climbing fast. The market is finally speaking, and it's screaming for quality.
Which leaves us with the critical, multi-billion-dollar question for anyone analyzing a company these days. When you see that carbon-neutral claim on a product or in a report, is it a genuine asset that reflects a solid climate strategy? Or is it a ticking time bomb, a hidden liability built on a portfolio of junk credits that could blow up into lawsuits, reputational disaster, and regulatory nightmares?
For investors, for analysts, for consumers, understanding this difference is now an absolutely essential piece of due diligence. And as always, this is not financial advice.